Welcome to Plan B Trading. In this short segment, we ask the question, what is Forex? Each country has its own currency, a way of buying and selling goods. The USA has the US dollar. The dollar symbol is widely recognized. Other countries use currencies called dollars, for example Canada with Canadian dollars. To be more specific, the symbol is sometimes prefixed with the initial US to make sure we understand it is US dollars being discussed. In trading, the US dollar is given the abbreviation USD. This distinguishes it from the Canadian dollar and other dollar-based currencies. At the time of producing this video, 17 countries in Europe have officially signed up to the single currency called the euro. A handful of smaller countries have adopted the euro as their currency in addition to the 17. The symbol for the euro is like the letter C with two lines through it. In trading, the euro is given the abbreviation EUR. Although a member of the European Union, the United Kingdom opted out of using the euro as its currency, preferring to keep the pound or sterling as its currency. The symbol for the pound is shown. In trading, the pound is referred to as the British pound or the Great British pound and is given the abbreviation GBP. If you never leave your own currency area, you might never come across another currency. As soon as you head off to a different currency area or country, you might find the need for some of their currency for your day-to-day expenses. You could change or exchange your money with theirs at, say, a bank or bureau de change. The process of changing one currency into another is known as foreign exchange. This is often abbreviated to Forex or just plain FX by traders. Although this is called currency exchange, it is in fact buying one currency and selling another. There are always two currencies involved in an exchange, called currency pairs. I'm based in the UK and use pounds in my everyday spending. Whenever I travel to Ireland, France, Germany and other Euro area countries, I need to change some pounds into some euros. I look at the exchange rate to find out how many euros I can get for each pound. With this information, I can decide how many euros I want to buy or how many pounds I want to sell. The currency pair is abbreviated based on the two currency abbreviations. For example, GBP EUR. At the moment, I can get 1.25 euros for each pound. If the currency were quoted the other way around, it would show me that a euro would buy 0.80 pounds. It does not matter which of these rates is quoted, I can still change my pounds into euros or euros into pounds. This aspect of changing currencies supports my travels. However much I travel, my use of currencies is an insignificant part of the global business of currency exchange. The market in currencies supports the operation of the global economy. Businesses around the world trade currencies to support their business activities. The US dollar has the status of the world's currency. As the world's largest economy, its status as the world currency was established by the Bretton Woods Agreement in 1947. The significance of this is that commodities around the world are priced in US dollars, whether it is oil, gold or food. That means any country or business wishing to buy corn or oil-based products will need US dollars to pay for them. It makes the US dollar the most widely traded currency. All currencies trade against the US dollar. Each of the currencies traded against the US dollar is given a nickname. Trading the euro is called eurodollar, or often just euro. The British pound or sterling is referred to as cable, after the first cable crossing the Atlantic. The Japanese yen is called dollar yen or just yen, and the Swiss franc is called Swiss or Swissy. The Canadian dollar is referred to as the loonie or the Canadian. The Australian dollar is nicknamed the Aussie dollar or simply the Aussie, whereas the New Zealand dollar is called the Kiwi dollar or Kiwi. Over 3/4 of all currency transactions involve the US dollar. Traders in the Forex market speculate on movements or volatility in exchange rates. Before looking at an example, let's look at some of the reasons why Forex is so attractive to traders. The market size is significant. At $4 trillion daily, it's larger than all of the stock markets around the world combined. And there are just a handful of currencies to choose from, rather than tens of thousands of stocks. The liquidity of $4 trillion daily means price movements are more predictable. 24-hour operation of the market means you can trade at any time of the day or night to fit in with your existing commitments. Brokers provide massive leverage, allowing you to trade huge sums of money with a small deposit. Let's have a look at an example. At the beginning of week commencing Monday the 20th of August 2012, The exchange rate for euro-dollar was 1.2350. It means for €1 you will get 1.2350 US dollars. The first named currency in a pair is called the base currency. Its value is always 1. The second named currency in a pair is called the terms currency. The number or exchange rate is how many of the terms currency you receive for one of the base currency. Suppose I need to buy some euros. I am going to buy 200 euros. I'll be selling dollars for this trade. At the exchange rate of 1.2350, that means I am selling $247 to buy the 200 euros. I describe my trade as going long or buying euro-dollar at 1.2350. By Friday 24th of August 2012, the exchange rate has moved to 1.25. Let's close the trading position. Closing a position means doing the opposite of the original transaction. This means selling the 200 euros I bought on Monday. At an exchange rate of 1.25, the 200 euros will buy 250 US dollars. So I receive 250 US dollars when I sell my 200 euros. Check out the maths. Monday, I bought 200 euros and then sold it on Friday. The net number of euros I have is 0. Monday, I sold $247 to buy the euros. On Friday, when I sold the euros, I received $250. This is a net profit of $3. Okay, $3 profit is not much, I hear you say. It's still a return of more than 1% on my $247 investment in a week. You may recall a mention of leverage earlier. Leverage allows me to use a deposit. So rather than buying 200 euros, using typical leverage of 100 to 1, I would be buying 20,000 euros, or 100 times as much money. When I sold the euros, I would have received 100 times more money. This would provide a profit of $300, a more useful amount. At current exchange rates, a profit of $300 is around £190 or 240 euros. For many people, that kind of extra income just once a month would come in handy. By now, you should have a greater understanding of Forex and trading Forex. You won't carry physical cash to trade. You'll open an account with a broker, and all of your trading will be done online, over the internet. In many parts of the world, brokers offer Forex accounts to allow you to buy and sell currencies online. You'll be able to trade currency pairs, even if these do not involve your own currency. For example, my Forex account is funded in British pounds, yet I can trade euro-dollar with ease. A further frequently asked question, what is a Forex account, takes a look at the types of Forex accounts and how they operate, plus the costs and commission charges. In some parts of the world, traders can take advantage of spread betting to trade Forex. If you still have questions, why not call 0203 603 4983 and talk to a trader now. You can practice trading the Forex markets on Plan B's training programs. Get started by booking Trading 101 or have a chat with one of our traders by calling 0203 603 4983 now. You can find more information about coaching and our training programs, and you can book online at www.planbtrading.com.